Welcome to Module H27. Across H1 to H24, almost every task ended with a small ROI tracker, a few hours saved here, a percentage there. None of it was ever added up. H27 has one job: roll every scattered estimate into one honest number. What has this program actually been worth to your business? In H26, you spread ownership of your AI workflows beyond yourself, mapping risks, assigning owners, naming a champion, and building an onboarding SOP. That risk reduction is one part of today's calculation. Add to it every module's local ROI estimate, hours saved on financial records, faster customer replies, a growth opportunity that turned into real revenue, a bad decision avoided in H23, and you have the raw material for one consolidated AI ROI scorecard. Same tool. New job, add it all up honestly. By the end of this module, you'll have every scattered ROI estimate from H1 to H24 gathered into one list. You'll have converted every time-based estimate into a consistent, annualized rupee value. You'll have split your total benefit into three categories: time saved, revenue impact, and cost avoided. You'll have netted it all against real costs to reach an honest net ROI, meaning benefit minus cost, the actual value of what this program produced for your business. And you'll have signed a quarterly ROI review SOP so this number stays current rather than going stale. Let's start with why 20 small wins scattered across 26 task boxes convince no one, and what one consolidated number actually does. A dozen small estimates sitting in 12 task boxes are easy to dismiss, including by you. No single module feels dramatic on its own. When someone asks whether all this AI work was worth it, you can't answer with "Copilot saves me about 10 minutes here and 5% margin there." A consolidated net ROI answers that question with a specific number, one a bank could respond to in a loan application, one a business partner could evaluate, one your own CA could read without you having to explain it. 3 important rules before you begin. Round down when unsure. Exclude anything you can't defend. And treat this scorecard as something you could explain line by line to your CA. A net ROI built on inflated inputs is worse than no number at all because it will eventually be questioned, and one indefensible line undermines trust in everything else on the same page. Now let's gather everything, pulling every scattered estimate from H1 to H24 into one place before calculating anything. Your scattered estimates live in 4 places. Saved ROI tracker boxes from individual modules, the specific time saved and rupee value estimates you filled in along the way. Your H22 opportunity brief, H23 decision memo, and H24 roadmap, any revenue or capital avoided figures from your growth and decision work. Your H26 team AI adoption plan, time saved by no longer routing every workflow through you alone. And your memory, if a tracker was never filled in, a conservative estimate is better than an invented one. One important rule in the gathering prompt: ask Copilot to flag anything too vague to be useful and ask you a clarifying question rather than guessing on your behalf. Ramesh's gathered list was 4 rows. His 4th row, team capability work where the GST invoicing risk was still unresolved, was correctly recorded as 0, not given an estimated value that hadn't actually materialized. That honest 0 is what makes the rest of his scorecard credible. Task 1, pull together every saved ROI tracker box and growth document from H1 to H24. Open Copilot and run the ROI estimate gathering prompt. List everything you can recall: module names, rough time saved per week or month, any revenue or cost avoidance outcomes, and ask Copilot to organize it into a table with module, what changed, estimated value, and confidence level. Anything too vague gets flagged. Answer Copilot's follow-up question rather than forcing a number. Save your gathered list, it feeds task 2. Your list is gathered. Now let's convert every time-based estimate into one consistent, annualized rupee figure, because a weekly saving and a monthly saving are not the same thing. Your gathered list mixes weekly, monthly, and one-off estimates. Converting them correctly matters. Using the wrong multiplier significantly changes the total. 3 formulas. If the saving was per week, multiply hours by 52 weeks and then by your hourly rate. If it was per month, multiply hours by 12 months and then by your hourly rate. And if it was a one-off, a single task done faster just once, count it once only. Do not annualize a one-off event. That is the most common inflation mistake. Anitha's fashion boutique in Bhopal is a useful example. 3 hours per week saved on WhatsApp replies. 3 multiplied by 52 multiplied by her hourly rate of 250 rupees, 39,000 rupees a year. One item was a 4-hour one-off setting up her bank statement template. That was counted once at 1,000 rupees, not multiplied by anything. If you are unsure of your own hourly rate, divide your monthly income by 22 working days and then by 8 hours. That's a reasonable proxy. Copilot shows you the calculation for every line. Check it before trusting the total. Task 2. Open Copilot and run the time to rupee conversion prompt. Paste your task 1 list and your rough hourly rate. Ask for every time-based estimate converted to an annualized rupee value using the correct formula for weekly, monthly, or one-off, with the calculation shown for every line, not just the total. Check that no one-off saving was mistakenly annualized. Write down your total annualized time saved value. Save your converted list, it feeds task 3. Your estimates are converted. Now let's split them into 3 categories, because time saved, real revenue, and cost avoided are 3 different kinds of value, and a good scorecard shows all 3 separately. Time saved is what you've already converted, hours no longer spent on manual work, expressed in rupees. Revenue impact is new or additional money directly traceable to an AI-assisted decision, from H19's growth opportunity log through to H24's roadmap. Cost avoided is a penalty, dispute, bad investment, or margin loss that didn't happen because of a check you ran, a GST mismatch caught before a filing penalty, a feasibility check that stopped a bad commitment. Revenue impact and cost avoided need a higher evidence bar than time saved. They're easy to overstate with hopeful reasoning. This will probably lead to more revenue. The bar here is real and traceable. Actual signed clients. A documented averted mismatch. TechFix IT Services in Bengaluru had a revenue impact of 1,92,000 rupees from 2 AMC clients actually signed, not projected, confirmed. Their cost avoided from a capacity conflict caught in H24 was logged as a qualitative entry, not a rupee figure, because no real cost had actually been incurred yet. That's more honest and more credible than forcing a number onto something unquantifiable. Task 3. Open Copilot and run the benefit categorization prompt. Paste your task 1 and 2 outputs and ask for every line categorized as time saved, revenue impact, or cost avoided, with Copilot prompting you to confirm any revenue impact or cost avoided figure is real and traceable rather than a rough guess. Move any unverifiable revenue or cost avoided figure to a qualitative note rather than forcing it into a rupee amount. Write down your rough total for each of the three categories. Save your categorized list, it feeds task 4. Your benefit is categorized. Now let's subtract what this actually cost you and produce the one honest number that tells you whether the program paid off. A net ROI subtracts 3 types of real cost from your total benefit. Tool and subscription costs, your Copilot subscription annualized. Time invested in the program, rough hours across all modules completed multiplied by your hourly rate. This is a real cost even though it also produced the benefit. And any capital committed from an H23 go decision that hasn't yet been recovered in revenue, a trial batch, new stock, a tooling investment. Ramesh's scorecard, time saved on financial records and customer communications, approximately 68,000 rupees a year. Revenue impact from his second location supply line, a conservative 4,20,000 rupees discounted because only the trial batch was confirmed so far, not the full volume. Cost avoided from a GST reconciliation catch, approximately 12,000 rupees. Total gross benefit, approximately 5 lakh rupees. Costs, Copilot subscription roughly 6,000, roughly 40 hours invested across the program at his own rate, approximately 20,000, and the trial batch tooling cost approximately 15,000 not yet fully recovered. Total cost approximately 41,000. Net ROI approximately 4,59,000 rupees in the first year. A number Ramesh showed his CA without hesitation because every single line traced back to something specific he could point to. One sanity check before you finalize. If your net ROI looks unusually high relative to your business size, check your inputs again before trusting the number. Task 4. Open Copilot and run the net ROI scorecard prompt. Paste your task 3 categorized list and totals, your tool subscription cost, your rough hours invested multiplied by your hourly rate, and any uncommitted capital from H23. Ask for a one-page scorecard showing total benefit by category, total cost, and net ROI with the calculation clearly shown, and a flag if the net ROI looks unusually high relative to your business size. Sanity check the result and adjust if needed. Write down your net ROI. Save your scorecard. This is your H27 capstone deliverable. Your net ROI is calculated. In this final section you'll set the quarterly habit that keeps it current, because a number calculated once and never revisited goes stale the moment your business changes. A net ROI calculated once and never revisited is a snapshot of a moment that has already passed. 4 updates every quarter keep it current and credible. Update your time saved figures if any workflow ownership changed since H26. Update revenue impact with actual results from your H24 roadmap, replacing estimates with real figures as they become available. Add any new cost avoided instances from the quarter. And recalculate the net ROI with the updated figures. Run this review in the same sitting as your H24 growth strategy review. Both pull from the same underlying data, so combining them saves time and keeps the two documents consistent. One note on scope. This SOP does not replace your H24 growth review. It runs alongside it. Task 5. Set your next quarterly ROI review date in your calendar, aligned with your H24 growth review. Write and sign your commitment statement. You commit to updating your net ROI scorecard every quarter using Copilot, replacing estimates with confirmed results as they arrive. Save your scorecard and SOP together. They are your H27 evidence and the most important proof of value document in your capstone submission. Let's close the module and look at everything you've built. You've gathered every scattered ROI estimate from H1 to H24 into one list. You've converted every time-based estimate to a consistent annualized rupee value using the correct formula. You've categorized your total benefit into time saved, revenue impact, and cost avoided with a higher evidence bar applied to the latter two. You've built a one-page net ROI scorecard, benefit minus real costs, defensible line by line. And you've signed a quarterly ROI review SOP. Complete the test. If you don't pass, watch the 60-second hack video, then review the modules and retry. When you are ready, move to H28, where you protect this net ROI from the single most predictable threat to any program's gains, habits quietly stopping once the course pressure disappears.